Good morning, ladies and gentlemen. Well, it was a very hard week of trading, and I think that we are somewhere, I don't know, I think it's going to be very hard for the next several weeks because a lot of things are not making sense. The risk dial is mildly positive in the 30s, according to my calculations. And that doesn't really give us much of a clue. It says that the market is very volatile and very unstable at these levels. And I will try to explain why, because the bonds are doing things which I don't really understand. I have to completely admit that I don't understand why they're doing it now and where the terminal rate is. And that really makes everything very, very difficult to trade from my point of view because I don't know what the end game is. So, that having been said, I will now try to explain to you why I think that things are very unstable and where things could go. As I said to you a couple of weeks ago, I don't think the yield curve is going to be any kind of a predictor of what is going to happen for quite some time. I think the yield curve is going to make some highly convex moves and things which really don't make sense for the long term. If we look at basically where it is, we are now at the flattest levels that we have been, at any point in history. We have to go back to periods like 2006, 2007 to see a yield curve as flat as we have at the moment. Is the yield curve a predictor of recession? I think it definitely is. But what is the lag between the yield curve getting to recessionary levels and the recession happens? Anything between 9 months, 12 months, 15 months. So it's not an immediate predictor of anything. And in fact, when the recession does happen, it tends to steepen a hell of a lot. So all we can say is that we are in a highly unstable period, and every single tenure that you look at. So now this is 10s, 30s, 11 basis points. This is basically where we were back in 2018. Any kind of tenure you look, and even fives, tens. Here we are slightly negative in fives, tens. What does that say? That says that the market is awaiting some data, something that will give it an idea of what the terminal rate is, and in the meantime, it's just panicking, and because nobody really has a clue, and people are getting rid of their duration just in case. Nobody knows. The move, this is not the time to trade the yield curve and not the time to use the yield curve as a predictor. This just tells you that people are very scared. And if you look at the charts of what the individual tenures are doing, this is the 5-year note, you understand why people are scared and why they should be scared. I mean, this is a massive move. This is a move from the close last week from 215 to 257. 40 basis points in the 5 years in 1 week when we've had really no data that, sort of says anything at all about the economy. That just means that people are so uncertain as how far the Fed will tighten and what the ultimate terminal rate is. If I enlarge this chart, basically what we are doing is we are going to the previous highs of around 299, 3%. And this goes back, many, many years back. since we've been to these levels. It just impossible to trade sensibly something like this, and I would recommend actually leaving it alone and only trading at levels. The next level is 267, and you can see why. And maybe get some, you get some retracement from it, but I wouldn't bet $1 million on it. And if we have a look at the, every individual tenure is the same. This is basically a chart of the 10s. You can see that we've reached the 100% extension. Can I exclude that we reached the 138% extension around 3%? Absolutely not. These are the levels: 261, 273, 274, and then, 298, 3%. This is what, these charts are saying. These charts are saying that we could easily, within a couple of weeks, get to 3% and have an awful accident all over the shop. This is when you completely revert to buying options and have a very, very well-defined risk, and that's it. And you just leave it. You have an idea why you put it on, and that's it. You just have a very defined risk and nothing else. Could it go to 3%? I mean, absolutely. This is a time of panic. So I really don't know what to tell you, because the market is not giving me any clue as what the terminal rate is. The market is saying that it doesn't know what the terminal rate is. And when that happens, you can have some highly, highly unusual moves. If you told me that next week we went above 3%, I would not say that's impossible, because it's a question of liquidity, it's a question of positioning, it's a question of fear, not of sensible analysis. So anything is possible. What I do think is going to happen is that at some stage you will have again people looking at levels and saying this doesn't make sense. But that could take several weeks. This is now the 30-year, and can I exclude a move to around 320? Absolutely not. Every time we've done, we've bounced from these levels, this is where we've gone to. We've got to above 3%. And a 30-year which is above 3%, it's a problematic, it's a problematic market, because it makes equities so expensive. And that is the danger. Really, the danger is that we do see these moves, that we do get to over 3% as the terminal rate. And if you think that the R squared is anywhere between 2 and 2.5%, that says that the Fed has got a lot of tightening to do. And when that tightening happens, things are going to get very, very volatile in both fixed income and equities. I also wanted to show you a chart of TLT. This is a weekly chart, and to me 127.37 is basically the cutoff point between restrictive policy and basically lax policy. Every time we go through 127, we go quite a long way, and every time, both on the upside and on the downside. If we go through 127, I think there's very little to stop us until 115, or even down to par. And that is the scenario I showed you in the previous slide, when 30 years just go berserk and go to 3%. Now a 50 basis points move in 30 years is so restrictive on housing, on consumer durables because you have to fund all these expenditures. And that is what brings about the next recession. So to me, if we start trading through 127.37, as I showed you earlier, and I can show you again, this chart of 30 years, that means that we are trading up here. It means that we're trading 3% and higher in 30 years, and that is really something that is going to hit the economy for six. That's all one can say. That potential for very large moves is also embedded in Europe. This is a weekly chart of the bubble, and I've had to go to weekly just to show you how far back we are. We have to go to see these kinds of levels. This is 2015, 2014, 2013. We have bust through what I reckon was, sort of the last line of resistance, and now we could easily go even next week to something here like 61, 62 basis points. You can see how large these moves were back in 2012, 2013. We could really get some very large, and don't forget that this is the bubble, and in no way is the ECB going to tighten anytime soon. They are the most dovish. And here we have now the Bund, and if the Bund basically now breaks this 80 level, there's very little resistance until we get to these levels, which are 130. Yeah, so you can see how, this would be more than a doubling of the current yield. You're talking about 100% moves. And that is what really frightens me. Normally what tends to happen is the stock market hangs in. And when finally these moves, happen, you get an absolute slaughter in the stock market. This is now the clearest chart, and it's the French market. Okay, so you tell me, if the French market next week, the OATs goes through 115 basis points, where's it going? Well, it's probably going to somewhere around here, which is 211. These are just massive moves. The potential for them, what it's going to do to the economy is just absolutely kill it. So that is why I'm scared. And when I'm scared, I scale back. I only do options with very defined risk. I don't even do 2x1s because I can get killed on the 2 part of it if I'm wrong. So I'm just telling you what I'm seeing and the reasons that I'm afraid. What I'm basically why I don't really want to trade this until I can see, unless I have very, very defined risk and very good odds. The differential between the US and Germany, it's no surprise that it's going out as basically the US panics and drags Germany with it. But it's unsustainable at around 2% because people will just swap out. Can it get here? Absolutely. But I think that the longer term direction is going to be downwards. What this confirms is that the probability of seeing higher rates in everywhere is actually high. This chart isn't going to come down all by itself. It's going to come down because there's recession and all yields are plunging. But first, to have that happen, it has to probably trade up here and remain up here for a while, and then all yields can come off. But it's going to be a very, very volatile time. It's not the time to have strong opinions. It's the time to be very nimble and modest. Well, what's the dollar doing? Basically, nothing of the downside. These ideas that after the first rate hike you will get, the dollar weakening, I just can't see it because we just don't know what the terminal rate is. In fact, we have now we're getting panic as to what the terminal rate might be. To me, the dollar is just not a sell as yet. The dollar will be a sell when the terminal rate is known and the differential between Europe and other countries and the dollar and the US is known. Until then, the fact that there is this uncertainty and that the terminal rate could be in the threes, which is like 100 basis points over R squared, which guarantees recession. It just has to guarantee recession. Is the reason not to sell the dollar. I'm not saying it's a reason to buy the dollar, but it's certainly a reason not to sell it. If you have dollars, you are quite happy holding them. You have absolutely no, you're getting positive carry and you have fear in there and you have no reason whatsoever to buy a currency like the euro or the yen. Why would you? So to me, the likelihood of going up here towards 139 or 99.83 is higher than the likelihood that we fall into the 95s. I have absolutely no reason to bet against the dollar. And if we have a look at the euro chart, to me, it's much more likely a continuation down than a reversal. Who would want to buy? Why would you want to buy euros and hold them? I just see no reason whatsoever for that. If I enlarge the weekly chart, it's far more likely to test these levels again, which is, 108.70. And this is like the lowest close before the lowest close. And you can see how we just could not close below that level at, here. Every time we tried, we closed back within it. So that to me is key. If we close below 108, 108, the figure, it's just going to keep on going down to probably par. To me, there's absolutely no reason at the moment, no fundamental reason that I can sell to start betting against the dollar as yet. Gold is a tough one now. It really is, because, if bonds go to those levels that we talked about earlier, it has to it has to keep gold in check at best, or make it go down at worst. If the dollar is not going down in value, and if interest rates, long-term interest rates in the States can spike, then that really has to be not good for gold. I, as I told you, as said to some of you, all I do is I sell puts around the 1881 short-term puts and leave them because I'm quite happy to own gold there. I'm not really sure I'm even going to do that this week. I think the danger, because the instability in the bonds is so high, that if we get those moves that we talked about, I think it could, one day someone comes in and sells gold and we're all the way down to, sort of this kind of level, 1830 at the 200-day moving average. No, to do an ABC down, no problem whatsoever. I'm basically scared of touching any asset, and I'll show you on the spread to bonds and to equities where we are. This is a very long-term chart of TLT against gold, goes all the way back to the early 2000s. And you will remember, some of you will remember this level when I said in 2020 that this is, gold is breaking down again. Gold is showing that TLT, that bonds are going to start breaking down, and then gold is a much better investment than TLT. And in fact, since then, since sort of the middle of 2020, gold has been a much better investment than TLT. But you can see where we are. We are coming to the basically all-time lows in that spread. What could that mean? That could mean that, sort of it keeps on going a bit and then does a huge retracement. Now, the question is whether it's going to be because of TLT or it's going to be because of gold. I don't know, but all I'm saying is that we are at very, very stretched levels. And if TLT keeps on going, high likelihood that gold actually goes more than TLT. So this is something that also worries me a lot. If anyone has any good ideas of what it's indicating, please tell me. But to me, this is a very, very unstable period because everything is at great extremes. And gold against DBC is also just about to reach the levels where it's cheap. So you can see you have, on the one hand, you have things saying gold is expensive. On the other hand, you have things saying gold is cheap. But these are, I've been saying from round here that, don't buy gold, buy DBC. But now I have to start changing my mind. This is like a 30% move. And now I have to start saying, well, gold is going to be a better investment than DBC at some stage very soon. Could it be another year before that happens? Yes, but I'm quite convinced that this kind of level will be seen many times again in the history of this contract. You can see where we were a lot lower. Could it go lower? Yes. But it's quite certain that within a few, so whatever happens, we will see these levels again. And the reason why DBC GLD is so unstable is because of oil. We haven't seen a weekly close above 110.53 since, we can go all the way back to 2013. And that's basically it. We've never seen a close since the great financial crisis above that level. And now we're seeing it. Is this saying that we could go all the way to 130 again, 150, 200? Yes. And it's saying that we are in a at a very pivotal time in financial history. Things could really start getting stupid from here. And I guess you have to start looking, you have to keep on looking at oil to give you a clue. Because the reason why the market could panic in bonds is because you get an outsized move in oil. Would I exclude something happening in the conflict between Ukraine and Russia and this thing really starting going berserk on the upside, even though governments are releasing a little bit from their reserves and so on? No, I can't exclude it. And this is what is so worrying, that you could get some outsized moves in everything, in bonds, in oil. It's very, very frightening because the instability is very high. Now, this is a monthly chart of oil, and really you can see that every time it closes a month above 114, let's call it, it has, an outsized 20-30% move on the upside again. So it's really not excluded that that can happen. If you have a look what happened in 2008, basically it caused the recession. It caused the recession. It was a financial thing. But when the recession hit, it went all the way down to 37. And that is what could happen again. Oil just spikes to new highs, 150, 200, and that causes a recession in the US, and then it collapses all the way down into 75, down to 37, whatever. But it just shows you the volatility that could be ahead. If you got a move of, say, $40, $50 on the upside, bonds would definitely panic. Okay, bonds would definitely panic, reach 3%, 50, 70 basis points over R squared. That absolutely hits the economy for six, and that's it. So this is the kind of moves that we are talking about. And absolutely no revisions down by the, by people expecting earnings. They are just keep on upping the earnings higher and higher and higher, and that is why it's terribly unlikely that we get much lower equity prices in the near term. I think it's going to stay between times 18 and times 20. And the only thing that can really change that is a complete blowout in the bonds. So I would have thought that, anything above, we'll look at it in a moment, but anything around 4,600 has to be a sell for the time being, or a buy puts, because I just can't see with the bonds being doing what they're doing, unless they start reversing. I just can't see that the market can withstand times 20 earnings. And here we have weekly XPX. As you can see, after 45.94, there's nothing until 46.97. And we have regained the moving averages. Now, why are equities bid? I think equities are bid because they are the cleanest shirt in a very dirty laundry basket. And people are panicking out of bonds. They're not buying gold. They are very uncertain as to what commodities are going to do. And they're saying to themselves, well, earnings expectations are still rising. And I do have some kind of protection against inflation if I buy equities. So it's a faute de mieux. It's not that they are enthusiastic about it, but they're seeing they're not going down, and they seem to be the one that's being affected the least by what is going on at the moment. So they're buying them. It's as simple as that, I think. And I also wanted to show you my cleanest of the clean charts, which this to me is important. We're not yet overbought. And that is because people got so scared and so panicky on the downside when we were doing this, that they dumped everything they had, and now they got nothing. They're chasing this market. It could easily go to 46, 47, because every time we've gone through, we've done very, here we topped out, and I suppose I could put in a line here at, 45.90. Yes, 45.90 is going to be resistance, but I really wouldn't be surprised by even 46, 47. With a bit of resistance at 45.90. And as I say, it's not that equities are strong. I think that the equities are strong relative. And let's have a look at some relative charts and see what could happen. This is a daily chart of SPY over TLT, which has basically gone to new highs. I was completely wrong. I thought it would stay in this range, but it's gone. And that basically indicates that people are abandoning bonds. That the flows are very strong, and out of bonds they will buy equities. The other chart here is a weekly chart of SPY over DBC. And as you can see, basically, this is from 2018. It basically spiked, and now it's come all the way back down to where it was in 2016, 17, 18. And I guess what people are saying is that SPY over DBC is not really a bad levels to actually start putting on longs in SPY. At worst, it's going to do a bit of a dead cat bounce. So, you don't know where to put your money. This is quite clear, and this is not a bad level. So if you're juggling a butterfly between bonds, equities, and commodities in general, including gold, you are going to say, well, it's not such a bad spot to own equities. If you don't, nobody's going to fire you for owning equities, and therefore, I think that is what people are doing. They're just buying the most liquid and the best equity market there is out there, which is the SPY, and that's why it's not going down, and that's probably why it's going to keep on rising until you see evidence of recession. I think evidence of recession, though, is going to be a long time in coming. I keep on looking at this chart of transports, and this is just not the kind of pattern you have ahead of a recession, ahead of an imminent recession. We are basically at the same level as we were in October of last year, when the thing which was furthest from our mind was some kind of recession in the US, right? And this is not a pattern which suggests, this is an inverse head and shoulders, if anything. So it's more likely to test the all-time highs. And don't forget that this thing never really closed anywhere above 16,900. Never. Not a single weekly close apart from this spike, which was Avis or Hertz, I can't remember which, but makes no difference. This was rubbish. Okay, this was just ridiculous trading. So this is 16,900, and we are 16,300. What are we? 3-4% from all-time highs in the transports. And I would have thought if anything's going to forecast a recession, it's going to be the transports. But no, absolutely nothing there. And therefore, that to me indicates that the path of least resistance for the transports, at least, is still upwards. And therefore, this might have, slight, this is the industrials, of course, this might have slight moves down, but this is as bad as it gets, 34,000. And otherwise, still opening the Bollinger Bands, and up we go towards 36,000. That's all I can see. Even the market, which is the most impacted by the bond debacle, which is the Nasdaq, is actually not trading all that badly. What I would expect from the Nasdaq is that it touches this level, 15,100, 15,200, where you can see this whole region there, and basically that's where it backs off. That's why I think that the S&Ps will back off somewhere in the, around the 4,600 level, retest lower, and then probably go again. That is the kind of thing I would expect, but I definitely expect Nasdaq to trade that level over the course of the next week. I just don't see anything that's holding these markets back. I think I can see what's holding them back on a relative basis, but I can't see what's holding them back on an absolute basis, i.e. recession, we have to trend down in equities. That is just not happening, and that will not happen for a long, long time, it seems. Even the Nikkei, which has been weak relative to other markets, especially the SPY forever, has basically got back to my 28,180 level. And you can see how basically every week since 2021, it's traded that level. You know, up, down, up, down, up, down, but basically it's been trading 28,180 and back it is. Now, of course, it's back because of the currency. It's not back because of the strength of the Nikkei. But this is, to me, another indicator that it's not equities that are going to go down until there is a recession. Equities as an asset class are still bid. And the equity as an asset class which is going up the least and therefore makes the most sense to short or relatively short is Europe. Europe last week did absolutely nothing and just could not close above 3,844. It is, you know, I really wouldn't be surprised to get a squeeze in Europe next week up to 3,986 and then a collapse, which would basically, and this would mark the high probably in SPY, and then SPY backs off 2-3% while Europe backs off 10. You know, that kind of behavior. A move in the DAX to around 14,700, 14,800, and then a back off. That kind of behavior in Europe would not surprise me, and that is why I don't think that the S&P will be under pressure next week, but it'll be under pressure in a couple of weeks' time. I just don't see any point in selling S&Ps until it's at really overbought levels, and everything that I'm looking at the moment is just not saying that. From my point of view, the stock markets in general and in the US in particular are not going to enter a bear market until we see the US consumer give in. Whether it's because of mortgages, whether because housing prices collapse, or the consumer just basically throws in the towel because it can't finance the new credit card levels, or, you know, sort of can't take out any more loans because it's too leveraged, or whatever. But it has to come from the consumer. This is equal weight consumer against equal weight discretionary, and as you can see, it's flashed a warning. It started flashing a warning back in December of last year, and it's just not making new highs. It's making new lows. So on the other hand, this is SPY over XLY, and that is really not doing anything much. It's, you know, it's also showing that SPY is outperforming XLY, but it's not really dreadful. I mean, we are still at the same levels that we were in April, May of last year. So really what I'm looking for is this to start closing higher, making new highs, and this to start making new lows. When that happens, then I'll be much more comfortable shorting equities even outright. But at the moment, I don't think that that is the situation. I think that these charts are going to go sideways for quite a while, and that is going to buoy up equities as a relative asset class. Just one last look at SPY, and I just want to show that the RSIs are just not overbought, and that is why I'm being so patient and not looking to short it, because A, it's the strongest of the stock markets, and B, it's just not overbought, and I think people are actually underweight equities. So I would have thought even Monday, Tuesday, 45.94, and then it really wouldn't surprise me if it, backed off back to 45.43 and then went again. So it's going to be a very, very tough trading period. for several weeks, because there is every reason to expect overall weakness in the market because of what the bonds are doing, but yet relatively the levels aren't too bad. So I really have no rush and no intention of rushing into shorts, especially in the US, and probably not until Europe has actually squeezed everyone out of shorts. And then probably, as I showed you earlier, you can have a general bit of weakness in all the stock markets. But I don't think it's going to be huge. You're not going to see general stock weakness in stock markets again until you see a weakness in the US consumer. Lastly, I want to have a look at volatility because it has been leading the market or predicting what the S&P is going to do very well indeed. Once it broke through 30, it never looked back. And it's still showing that we will probably trade these kind of levels, 16, 17 over the course of the next week or so, because that's what it tends to do. It tends to make the move and then go sideways for like 4 or 5 days and then do another move counter-cyclically. And what I want to warn you about is this gap here around between 34 and 35. And I bet you that at some stage we fill it. But I don't think it's going to be in the next week or so, because I think the market does this. And this is what it tends to do for a couple of weeks, and then it goes. So to me, it makes sense that the market takes fright ahead of the Fed. And that is not, it's not going to do that until the last week of April or something like that. So to me, it makes far more sense that the market goes sideways in the next week or so, and then it has a little scare. All right, so finally we have the tables. I've updated everything, and I think really you have to start. Every time there's a pullback in bobble and buns and OATs, you have to buy puts in the futures, because that is definitely the path of least resistance. And I'm more than sure that at some stage you see these levels in the 5s, 10s, and 30s. There is no reason that the panic is going to be over for quite some time. The liquidity is so bad there that really there is no one willing to take on big positions unless they have big discounts. In these kinds of markets, reasonable valuation is not enough. You want a big discount to take on big positions. So I think that the bonds keep on performing badly relative to equities, and equities relatively well to everything else. The levels are updated, but as I've told you earlier, don't be wedded to any position, because the volatility in certain asset classes like bonds could get quite extreme. Thank you very much indeed, and tweet you on Monday.